This is the real estate lie that every guru on YouTube is talking about, but it's not actually true. Because having to not use money to buy real estate is absolutely absurd. And for people who don't have money, to believe that they don't have to use their credit is even crazier. Every time somebody has a question about real estate investing, they always ask me, how do I not use my money and how do I not use my credit? So today we're gonna deep dive what this actually means when gurus tell you that you don't have to use money or credit to buy houses. Let's go. What's up guys, it's your boy, this is me taking action. Definitely go ahead and subscribe to the channel, but more so click on the link below so that way you can get weekly real estate investing advice right to your inbox. Now today we're actually gonna debunk one of the myths that I hear a lot. Can you buy houses without having to use your own money or credit? And the answer is yes, but that doesn't necessarily mean no money, no credit. It's just not yours. So in the traditional means, in real estate, typically, this is how it's gonna go. You're gonna call a bank, a broker, or a local credit union. They're gonna give you some kind of pre-qualification factors, down payment, pull your credit, show me your IRS records for the last 2 years, bring me pay stubs, right? You're gonna go through this rigmarole, I call it. And essentially at the closing table, you have to be able to bring that down payment down along with your insurance money, along with the property taxes and closing costs for that particular deal. And so a lot of the times that'll turn out to be 6 to 10% of the actual purchase price. For some, other loans like conventional loans, you'll end up bringing 20 to 30%. So for most people, they're thinking, I need to have an 880 credit score and up, or I need to have $20,000, $30,000, $40,000 to put down to get the house I want. So I understand why everybody's like, I gotta believe in these guys on YouTube. I gotta believe in all of these gurus telling me that I don't need any money, okay? And so when you guys come and ask me questions, you're asking me questions as though you really don't have to put any money down. You do have to put money down, you just don't have to use your money. And let me explain. The reason why banks want you to put money down is because most of the time, using the traditional means of qualifying for a loan, you're gonna use the traditional means of buying a property, which is going through a realtor. Okay, so realtors contract with the owner of a property, okay? And they say, hey, I'm gonna sell your house for the most money possible, whatever that number is. And whatever the most money is, I'm gonna get paid a commission off of it. So the realtor's job is to sell properties at the most amount of money possible. So the banks are expecting you to pay the most amount of money. And so what protects the banks from doing bad loans is being sure that you have skin in the game, your down payment, which brings down their loan amount a little bit lower than what the house is actually worth. Is this making sense? So numbers wise, if the house is worth $200,000 and you have to bring in 5%, then essentially you have now made 5% equity. So if the bank would ever have to take the property back, it's just a little bit more than what you actually owe them. Now, on the opposite end, a real estate investor that's not bringing in any of his own money or not having to use his credit, the way he's able to do that is because the deal is so great, it's so good, if the bank has to take it back, they make way more money than the interest guaranteed anyway. So for example, a real estate investor is not gonna go through the traditional route. They're not gonna use a realtor and they're not gonna pay the most amount of money. The way they're doing this is they're going directly to the seller. So they're putting out some kind of marketing or putting out some kind of lead generation system to get people to reach back out to them via phone, online, or some kind of mailer or something like that. And when they talk directly to the seller, to the homeowner, of course, they're able to use, their strategies of negotiating to get better deals. And more than likely, someone who's just purchased one house in their lifetime versus a real estate investor that's purchasing hundreds a year, they're gonna more than likely be able to negotiate and kind of strong arm a good deal. Now, if a real estate investor hypothetically is able to get a $200,000 house under contract for $100,000, and that leaves $100,000 of equity, why would a bank or lender ask for any money down or ask for any kind of credit? Because at the end of the day, the worst case scenario for a bank is them taking the property and selling it to someone else and then having that remainder for themselves. That is the little trick to real estate. It's not that they don't need any money, because they do, because somebody has to give us the money to buy the property. We don't have to use our credit just because the deal is so great and there's so much equity. Now, how do we actually, or not necessarily how, but who do we reach out to? Because if we're not going to go to a traditional bank to do these kind of deals, who's lending the money? What banks are doing this? Well, here's a little homework for you to do right now before you leave this video, okay? You need to start researching small local banks in your area, investment banks. Maybe take some time to drive around your city, and whenever you see a new construction or rehab building, look at the sign. A lot of the times, banks that are lending on new developments or big rehab projects, they'll put a sign that says funded by and the credit union name. Go into those banks and say, hey, look, I'm a local investor. I saw that you were investing in this property down the street. What's your criteria? What deals are you looking to invest in this area? And when they answer that question, they're telling you what deals they want to fund. And all you have to do is go out and find a deal for them to fund. Now, it's really as simple as that. These are called debt service coverage ratio loans. That means that they're basing the approval not off of you, not off the credit that you have or the money that you have, but simply based off the deal. The deal that you're buying will make enough money every single month that will cover the mortgage, and you will be able to take home profit after the mortgage, taxes, insurance, and maintenance. Isn't that cool? Now, if you want to learn how to go direct to seller and find these kind of deals, just simply subscribe and go through our list of videos. We have several hundreds of videos teaching you how to do this. Until next time, be good.